like our break time.
All right, so mine is marginally similar to Stu's, but I'm going to try and take it a little next level. We've heard a lot about the numbers and like you got to hit your street numbers, and we haven't really learned what they are, how they sort of present themselves, and where they come from. So I figured I'd go into that a little bit. I also have some like random things that I kind of want to share at the end. I know we're supposed to keep this like very focused, but I didn't, so sorry. So what we have in an investment bank is they're going to have three arms. They're going to have their capital markets people who actually do the IPOs, and they tell you how much stock you should issue and how many bonds you should sell. They have a sales team that pushes the stuff they're trying to sell, and they have this research arm. And the research arm are the analysts who actually come up with the consensus estimates, and they model out exactly what the numbers they want you to hit are. So, you know, they don't care, the companies in general don't care about like retail investors, you or I. They care about pension funds, mutual funds, these big guys. And the sales team has relationships with all of those. So you're going to try and impress the analysts at the investment banks that have the best relationships. And also, you know, in theory, they keep the analysts separately because it creates insider trading and all different types of problems. And that's an in theory because it happens. So here's just an example of a research report that I pulled on Cisco. And I kind of highlighted some things. So up there where it says beat, that means that they beat what their expectations were. Down here we have company data, which you might call key performance indicators, over to our pal Wayne. Up there you have their rating overall, and Cisco unfortunately is an underweight, which is not good. If that's compared to your portfolio, so overweight is good, hold is neutral, and underweight is you should start selling this stuff. And they have the target price of $17, and it's at 29 right now, so that's not good. Also, guidance. So that's what the company is saying about their future revenues. So it gives the analysts some kind of stuff to model on. And then this guy's middle name is X, and I thought that was really cool. So here's just what they do with the financial statements. You will see the income statement, the balance sheet, and the cash flow down here. And what they do is they'll have the actual, which will be followed by an A, and then the E will be the estimated. So that's what they're projecting forward. And then here's another thing that I think is interesting and something that Cisco really likes to do, is they'll say that year over year, we have all these great growth numbers, but if you look at quarter over quarter, it's not looking all that good, except for that one, which is collaboration. So year over year is saying like, we just finished second quarter, this is what it's compared to second quarter of last year, so it's got a seasonal kind of flavor to it. But Cisco isn't really a seasonal company, so it's just kind of something that if it makes them sound better, they're just going to say it. And then quarter over quarter is sequential, so that's how you're really going to know how the company's doing. And the story isn't quite as pretty, unfortunately. But it's just kind of something to look out for. And here is a table I pulled of a bunch of different analysts. So this is just maybe half of the people who are listed as covering Cisco. But it gives all their recommendations, and it's all over the board. So that's interesting just to kind of think about. Moving on, something I think that we didn't really touch very much on is the concept of capital returns. And stock buybacks is the Cisco method of saying that our earnings per share, we'd rather go for the share count rather than the actual earnings piece. So it's a strategy to keep the stock price up when you have to do this transition to more deferred revenue. And it's also something that I think is very interesting, where activist investors are hammering these companies to start buying back stock and paying dividends rather than invest back in the company. It's something to look out for, especially because companies are going to have to start going on the defensive and buying back stock. But there are companies like Amazon who don't do that and are immune, so it's good that they're buying hardly. And finally, I thought that our conversation with Wayne didn't really capture enough nuance for the lawyering aspects of these things. Like his definition of bankrupt, I kind of thought it was wrong. So when we're talking as lawyers, it's kind of a term of art. It's like they have filed for bankruptcy. So whatever his definition was, if you talk to a lawyer and say, well, they're bankrupt, they're just going to be very confused by talking like that. And then he didn't really, in his Cooking the Books presentation, he never like said anything about 10b-5, and that's the rule that bans a misstatement while you are communicating something about a security. And then also, I felt like he failed to kind of capture the fraud spectrum, where it's kind of like, on the one hand you have fraud, which is Enron style. On the other hand, you have like kind of, it might be considered fraud depending on who's looking at it. There's some stuff that we don't really know. And then the example of leaving the books open, which Bill hit on, which is, that's fraud. And you said, you talk about it in the conference call after the fact, and that's what you do because it's protected by a safe harbor. But then you have options backdating, which everybody was doing, and it was kind of fraud. And he just kind of flashed it on the screen without actually explaining the nuance of what exactly it is. So I think that's something that everyone should be on the lookout. That's it.
Comments?
I would say maybe be careful with tone. I don't think that either of the things I'm about to say are what you meant them to come across as, but like when you started in the beginning and you're like, I know you're supposed to keep it super focused, but I didn't, sorry. It felt a little to me like it was like, I know that I only had so much time, I don't care. Sorry, I'm not sorry. And then also be a little careful with some things you were saying, Wayne said this was this and it's not. And like, so you can really avoid drawing that comparison, but in other places it didn't really feel like it was necessary for you to be like, Wayne didn't do this, Wayne didn't do that. And it felt a little unnecessarily aggressive, I guess.
Stu?
I thought you did a decent job of bringing my presentation.
Wrong word choice.
No, I mean, I liked it a lot, and I liked how you picked out certain aspects of it and kept the tone conversational. But I don't know, like I felt like I was having a hard time like trying to keep it, because it seemed like it jumped a lot for certain aspects of it. But like I thought you did a really great job of like conveying some of the more intricacies that Cisco's trying to do, and we're like upfront and said like, this isn't good that Cisco's like this. I thought that was like kind of refreshing to hear like something from somebody that's like, oh no, this is something that's not good for my company that's going on, but like you understand that and clearly like stated it.
I thought you had good speaking tone. I could keep up and stay engaged.
I liked that you went into detail. Like I liked that you picked one aspect of your company, well, kind of one, right, and then subsets of that, and went into it in a lot of detail. I think the hard part for a presentation like this is it makes everything, if you've stepped away and looked at your own font up here, but it's really tiny. And it's something that I struggle with too, where sometimes I overpopulate slides, is getting things really tiny sometimes, and in an ideal world, which I know you were not asked to do here, obviously we'd have a handout and we would be able to follow those numbers. And I struggle, so I don't know the answer, I'm just commenting on this, that having a lot of detail, like the numbers you wanted to show. It's hard to pull that out, but maybe what you can do is put a PDF and then zoom in. Yeah. So you show us the big page, and then your next slide is actually a zoomed in piece of the numbers you really want us to be able to see. I appreciated, though, that you did use a pointer so you could call our attention to that, though. I thought that was a really good presentation, so
So I thought your focus on what the bankers do, what the analysts do, and what they're looking at and why it's relevant was really good. I echo the comment that that slide has way too many bullets on, way too much text on it. But I thought the way that you took the analyst report and you highlighted a few things and worked it with the pointer was really effective. I mean, it was a good way to go and say, all right, you get this thing and your eyes glaze over the moment you see it, but here are 4 things that are really key on that. I would echo Jesse's comments about sort of tone, and I think you did something extremely dangerous in going and taking overt shots at Wayne. And I also think you're wrong on a number of the points that you made. I just think you're flat out factually wrong, and in the different audience, that'll get you slaughtered.
Yeah.
All right.